We're jumping straight into hyperscale data today.
Let's do it.
A lot of people are, watching the daily price moves. Maybe they catch a headline about a spike. But if you're just focused on that chart noise, you are absolutely missing the real story.
Which is this massive strategic pivot they're in the middle of.
Exactly. One of the most drastic we've seen in the infrastructure space this year.
It really is a complete reinvention. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Yeah, and if you're enjoying the show, make sure to subscribe and hit that like button. It really helps the channel.
And definitely drop a comment. Let us know which company you want us to break down next.
So the why here is just fascinating. Hyperscale Data was, for the last couple of years, this sort of sprawling, diversified holding company.
A bit messy, right? A mix of legacy industrial assets, some manufacturing.
Very messy, all bundled together. And now they are just aggressively shedding all that complexity.
And focusing. Tighten that focus into a pure, two-pronged infrastructure vehicle.
And those two prongs are aimed squarely at two of the biggest secular trends out there.
First, they're building out massive AI data centers.
And second, they're running this bold, very proactive Bitcoin-backed Treasury strategy.
So if you want to understand the future value here, you have to understand that shift. It's the single most important driver.
All right, let's look at the bull and the bear case for hyperscale data right now. We'll start with the bullish argument.
Yeah, which is really all about this convergence, this simultaneous leverage. You've got AI compute on one side.
And digital asset cycles on the other. It's a potent mix.
It is.
Yeah.
Let's start with the AI infrastructure side, because the scale they're targeting is, well, it's almost hard to believe.
We are talking about their Michigan data center. Right now, it's running at a modest 28 megawatts of capacity.
Right.
But the roadmap they laid out is to ramp that up toward an enormous 340 megawatts.
That 340 megawatt figure, you just can't overstate it. I mean, that's not just a spending plan. That's a multi-year ambition that, if they pull it off, gives them this massive runway for high-margin compute revenue.
It sounds insane. What's the biggest hurdle to hitting a number like that? Is it just capital, or is it getting the power?
It's both, but power sourcing is often the first real bottleneck.
Right.
You have to secure long-term, reliable power agreements at utility scale. And with AI demand chewing up grid capacity, that's getting harder and harder.
But they're definitely surfing a big wave here. The macro tailwinds are huge.
Oh, absolutely. Hyperscale data center capacity is projected to double globally every 4 years.
And AI is the engine driving that.
It is. And crucially, they've already proven they can handle the technical side of this, which is a major proof point.
You're talking about the NVIDIA GPU cluster.
Exactly. They completed the installation for a pretty sophisticated Silicon Valley cloud services client.
So that's their reference customer. It tells the market, hey, we're not just building a big box.
Yeah. We can handle high-performance, high-density AI infrastructure. It validates their credibility and, opens the door for other big AI clients.
But they're also trying to create an operational edge, something beyond just having the GPUs, this moat they talk about.
Yeah, so they're integrating AI into their own operations. They're not just selling you the space.
What does that actually mean?
It means using AI for power distribution across the campus, for automated thermal optimization, stuff like that.
And the client cares because
that automation ultimately lowers the client's operating costs per unit of compute. It's a direct saving for them.
Okay, so if you're running heavy AI models, you look at them and see not just the hardware, but a lower bill at the end of the month.
Exactly. It makes them sticky. It moves them from a commodity real estate play to a tech-enabled service.
That's prong number one. So let's talk about prong number two, the Bitcoin Treasury play.
Right. And this is where the stock gets a lot of its excitement and a massive amount of sensitivity.
This is where the balance sheet becomes highly levered to crypto cycles.
And management has been very explicit here. Their goal is to build a $100 million Bitcoin hard asset treasury.
They're doing that through a mix of mining output and just straight up open market buys.
And the market is absolutely paying attention.
I mean, they recently disclosed their holdings hit about $41 million.
And that single announcement drove, a nearly 15% stock increase in one day?
A 14.8% jump.
Mm-hmm.
But the key number, the one you have to focus on, is the exposure.
Mm-hmm.
$41 million represents a staggering 44% of the company's entire market cap.
Will you let that sink in?
Yeah.
For every dollar the company is worth on the market, 44 cents of that is tied directly to the daily price of Bitcoin.
That is not a hedge.
No. That is a massive directional bet on the future price of Bitcoin. It's why you hear analysts calling it high beta play.
Right. When Bitcoin moves, this stock is basically engineered to move more, amplifying the ups and the downs.
And they clarified their strategy too by cleaning up the portfolio. They sold off other assets like XRP to become Bitcoin only.
Which really simplifies the story for investors. It's AI and BTC, period.
Yeah, and this whole strategy creates what people call embedded optionality.
Meaning their valuation is now structurally tied to Bitcoin cycles.
So if Bitcoin rallies, the book value growth of hyperscale data can accelerate way faster than a typical data center operator.
Okay, let's touch on the smaller plays that add some flavor here. Specifically, the launch of that U.S.-regulated decentralized exchange.
The DEX, right. Through alt markets, this is sort of the third layer of optionality, their fintech angle.
They're aiming for, what, up to 175 countries?
Yeah, and the key word there is regulated. Operating a DS under a U.S. framework could be their moat.
A compliance-driven advantage against all the offshore platforms that are always facing regulatory uncertainty.
Exactly. It might attract some institutional interest.
But let's be real, that's not a guaranteed moneymaker, is it?
Oh, not at all. The DX space is brutally competitive. Launching a new one is a tough uphill climb.
Right, so let's step back a second. What's the foundation that even makes this 340 megawatt build-out possible?
It's the legacy businesses. People tend to forget them, but they're not just dead weight waiting to be sold off.
That's a point that gets missed. The crane services, the electronics manufacturing.
That stuff provides diversified, resilient revenue right now while the big project is still ramping up.
But it's more than that, isn't it? It's the know-how.
It's the internal talent pool. Think about the engineering expertise you need for massive power grids, industrial cooling.
They have that in-house. They don't have to hire all that expertise from outside.
Exactly. The legacy business is basically funding and staffing the engineering for the future AI business.
Okay, so that's the bull case. Massive AI scale, a levered Bitcoin play, and in-house engineering support. But where there's that much leverage, there's always risk.
A ton of risk. So let's pivot to the bear case. And the biggest risk is the one we just quantified.
The financial leverage to Bitcoin. That 44% market cap exposure.
Right. The implication is crystal clear.
If Bitcoin has a sharp, sustained drop, the damage to their treasury buffer is going to crush the stock.
You're buying a levered BTC proxy, not a diversified infrastructure stock.
The second major risk has to be execution, right?
Execution and capital intensity. I mean, scaling from 28 to 340 megawatts is just a monumental task.
Where does the capital even come from for that? We're talking hundreds of millions of dollars.
Are they taking on debt? Are they diluting shareholders with more equity offerings? Any misstep in financing or construction?
Could lead to a giant, empty, very expensive data center.
And that ties into the third risk, the complexity overhang.
The conglomerate discount.
Yes. The company's legacy as this complex holding company can still confuse investors.
And if the market can't easily put you in a dox like a pure play AI stock, it might just give you a lower valuation multiple.
Exactly. So the market needs proof that they're divesting those other assets quickly and effectively.
Until then, some of the big money, the institutional investors, will probably stay on the sidelines.
For sure. And we should just reiterate the risk with the DX. It faces a huge uphill battle. That's a highly speculative revenue stream for now.
So with such a high-stakes, execution-dependent story, what should you be watching? We need a catalyst calendar.
The first things on that calendar are the financial filings. We need to watch for the upcoming Q4 and full-year earnings releases.
Critically important. That's where we'll get the hard numbers.
And you're looking for two things. First, actual revenue growth from the AI and data center side. Is that 28 megawatts making good money?
And second, the balance sheet. The real mark-to-market value of their Bitcoin holdings.
Then you have these potential mini catalysts. Management promised weekly updates on their Bitcoin accumulation.
So every time they announce progress toward that $100 million goal, the market might treat that as a small positive event.
Operationally, you need to see concrete expansion proof points.
Announcements. More megawatts energized at the Michigan site. Are they at 50 now? 100.
And crucially, new client signings. They need to prove they can actually fill all that new capacity.
Finally, you have to watch the macro forces. This stock is a passenger on two big external cycles.
First, a sustained Bitcoin rally directly pumps up the value of almost half their equity.
And second, you need continued red-hot demand for AI infrastructure. If the GPU boom slows down, so does their pricing power.
Look, when you connect all the dots, Hyperscale Data has effectively placed this high-stakes, asymmetric bet on the two biggest trends reshaping the economy.
They've done the hard work of pivoting and cleaning up the narrative.
The final thesis really is that this company offers significant optionality. It's a high beta, dual play on AI compute and Bitcoin.
The upside could be massive if management executes on that capacity ramp and the Treasury plan.
It's a classic high-risk, potentially very high-reward scenario.
That's the lowdown on hyperscale data for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.